Okay, so let us now resume our discussion on capital budgeting. Last meeting, we already had a discussion in the previous video, rather. We already had a discussion on the techniques that do not involve the time value of money. This time, we will focus on the discounted cash flow techniques. From the name itself, they take into account the time value of money. Discounted cash flow techniques include the net present value, internal rate of return, and profitability index. Again, that's the net present value, internal rate of return, and the profitability index. We also have a discounted version of the payback period. As mentioned a while ago, we call it the discounted payback period. So we will focus on these three: NPV, IRR, and PI. Let's start with the net present value. Pachyderm Moving is reviewing data related to a new moving truck investment proposal. The new truck will cost 116,000 and have a 5-year useful life. Management estimates at the end of its useful life, the new truck will be sold for $20,000. However, when calculating depreciation, the $20,000 is not subtracted from the cost. Therefore, at the end of the 5-year life, the truck will have a basis of $0. Pachyderm expects the annual net after-tax cash savings will be equal to $27,000. Assume an effective tax rate of 50%. Also assume the straight line depreciation is being used and that Pachyderm's management has set a 9% hurdle rate on similar investments. What is the net present value of the new moving truck? I'll give you a few minutes. Okay, go. Okay, so let us try answering this one together. If you haven't tried yet, okay, you may pause this video for a while. Subukan nyo muna, no? Subukan nyo muna. Okay, you may pause this video. Okay. Pause muna ha kapag hindi pa. Sige, I'm now going to give the solution. So what's the net present value? The net present value is the excess of a project's value over the cost of its investment. What do we mean by the project's value? The value of any asset, whether it's a project or whatever it is the present value of its future cash flows, discounted using an appropriate discount rate that incorporates the risk in operating the asset. Again, the value of an asset is the present value of its future cash flows. So in this problem, what we will do to arrive at the NPV, that's net present value, is to first take the present value of the future cash flows and then deduct the cost of the investment. Okay? So let's start. What is the cost of the investment? The cost of the investment is given $116,000. What's the present value of the future cash flows? You have $27,000 each year for the next 5 years. Okay? Each year for the next 5 years. So there you go. You are going to take the present value of this $27,000. We are lucky enough to have this already in an after-tax basis. We do not need to calculate anymore. Okay? Now, at the end of the 5th year, we can sell the machine for $20,000. But because at this point the truck will have a basis of 0, we will experience a gain. So that $20,000 minus a tax basis of 0 would mean a gain of 20,000. So we have to tax this amount. So there you go. 20,000 times 1 minus 50%. No? That's the tax rate, 50%. You will have $10,000. So what are the future cash flows that this project is expected to generate? You have $27,000 each year until year 5, and then you can sell the machine for 20K, taxable at 50%. Now, what we will do is to take the present value using the appropriate hurdle rate, which is set by management at 9%. The present value of future cash flows, the present value factor for 9%, 5 years is 0.6499. You can do it in your manual calculator. That's 1.09 divide. Press the equal sign 5 times. No? 1.09 divide. Press the equal sign 5 times. 0.6499. That's the present value of this $10,000. No? 20K less 50%. This 0.6499 PV factor, you can convert this to annuity by deducting 1. 0.6499 minus 1. Then divide by 0.09, the discount rate. You will have 3.89. This is the present value factor for an annuity. No? Annuity for 5 years. So the $27,000 each year should be multiplied by the annuity PV factor. And the lump sum of 10,000 should be multiplied by the PV factor. No? The lump sum PV factor, 0.6499. The present value of all future cash flows is 111,529. Deduct 116,000, you have negative 4471. That is your net present value. Correct answer is letter A. No? The closest answer is negative 4480. That's your net present value. Now, how do we evaluate the net present value figure? If the NPV is a positive figure, it will be a good project. It's acceptable. The value that it creates is in excess of the investment cost. If the NPV is negative, this would not be acceptable because the value it creates, in this case, it's actually negative, right? The value that it creates is less than the cost of the investment. So it's a comparison of the asset's value and the cost of investing in it. If the value is greater than the cost, the NPV will be positive. That's a profitable project. But if the value is less than cost, as it is in this case, it means that it doesn't create enough value to cover the cost of the investment. So this is not an acceptable project. Okay? Considering we have a negative NPV, this is not an acceptable project. Okay. So that is it for the net present value. Again, in summary, a positive NPV means that we recommend to management, we accept the project. Negative NPV means we recommend that management will reject the project. Okay, that's the net present value. Okay? Next, we may proceed to the next model, which is the internal rate of return. The internal rate of return is the true rate of return on the project based on cash flows. To demonstrate what this internal rate of return means and how is it different from the accounting rate of return, we can use the following scenario. If you can invest 100,000 pesos now, that will give you 120,000 in a year. What is the internal rate of return? So let's create the timeline. So now you will invest 100K. A year from now, you will receive 120K as a result of that. 120K minus 100,000, that's a profit of 20,000 divided by the 100,000. So you have an excess cash flow. Hindi pala profit, no? Excess cash flow of 20K divided by 100K, the net investment. The rate of return is 20%. You call this the internal rate of return. Okay? So, ang gagawin nyo, kunin nyo yung cash outflow sa year 0. Yun yung net investment. Tapos, kunin nyo yung cash inflow 1 year from now, assuming that the project will mature or will end in year 1. So 120 minus 100,000 divided by 100,000. That's an internal rate of return of 20%. No? That's an internal rate of return of 20%. Okay? So the internal rate of return is the true rate of return based on the project's cash flows. Now, you can only calculate the internal rate of return directly if you operate only for 1 year. If the project will be operated in 1 year, madali naman mag-calculate ng IRR. Ang problema, dito sa capital budgeting, mas madalas more than 1 year yung project. No? Here in capital budgeting, most of the time, the project will operate for more than a year. So we cannot calculate it this way. No? Pang 1 year project lang yung ganitong technique. So pansinin nyo ha, year 0, mag-i-invest ka ng 100K. Year 1, 120K. Again, we have calculated the IRR to be 20%. I want you to notice this. We have calculated the IRR to be 20%. If you use the IRR as a basis in arriving at the NPV, use the IRR as a discount rate, the PV factor would be 1.2, divide. Press the equal sign only once. You have 0.833333. Multiply it by the 120,000 cash flow. You would end up with a value equal to the investment. In short, the net present value will be 0. Okay? So, ito yung napansin natin. Kapag gagamitin si IRR as a discount rate, yung NPV natin nagiging 0. So, yun yung gagawin natin sa mga susunod na problem. No? Hanapin natin yung IRR sa pamamagitan ng paghanap ng discount rate na magbibigay ng 0 na NPV. Again, one more time. Pagdating sa isang 1-year project, madali i-calculate yung IRR. Napakadaling i-calculate ng IRR, basta 1 year lang yung project. Magkano matatanggap mo sa isang taon minus magkano yung puhunan mo. Divided by yung puhunan, no? So cash flow in a year minus 100K investment divided by the 100K investment, you have 20%. But moving forward, if we're going to deal with projects that would operate for more than a year, we cannot do this calculation. What we can do is to do trial and error. We will look for a discount rate that will give you a 0 net present value. Maghanap tayo gamit yung trial and error ng discount rate para makakuha ng 0 na NPV. Yung rate na yon ay ang internal rate of return. I'm going to give you the following problem first. Okay, I'll give you 1 minute for this one. The NPV figures for projects A and B are as follows for a range of discount rates. The approximate IRR for projects A and B respectively are go. Okay, kung hindi nyo pa nakuha, i-pause nyo muna yung video na to, ha? If you haven't got it yet, please pause this video. Okay. Pause this video if you haven't got it yet. Okay. Ang gagawin natin pagdating sa problem solving, we use trial and error to arrive at a 0 NPV. In this problem, everything is given to you. At a certain discount rate in this column, you're given the corresponding NPV for project A and B. Okay? The discount rate that will give you a 0 NPV is actually the IRR for that project. In the case of Project A, magzi-zero siya somewhere between 18 and 20. No? Somewhere between 18 and 20. Notice that Project A will shift from positive to negative. So the IRR is somewhere between 18 and 20. In the case of Project B, that number would be somewhere between 24 and 26. Tama, no? 24 and 26. Sa 24, positive yung NPV. Okay? Sa 24, positive yung NPV. Sa 26, magne-negative yung NPV. So the range must be somewhere between 24 and 26. So the approximate IRR for projects A and B respectively are, correct answer, dog. The only possible answer would be dog. 19.5% is between 18 and 20%. Tapos si 25.5% nasa gitna siya ng 24 and 26. Okay? So the only possible combination is dog. No? Kung titingnan niyo yung A, pwedeng 19, 18.5, 19.5, somewhere there, no? Tingnan mo si boy, somewhere sa 25, no? 24.5, 25, 25.5. Okay? So hanapin nyo kung saan magzi-zero out yung NPV. Anong discount rate yon? Kay A, nasa pagitan ng 18 at 20. Kay B, nasa pagitan ng 24 and 26. So the only possible answer would be letter dog. No? 19.5% si A, pasok. Si B, 25.5%, pasok din dito sa range. Yung C, malapit na, no? Kaso dun sa C, yung nagkamali yung C kasi yung B niya, no, 21.5 ang layo, no? Out of range naman. So the only possible combination is dog, no? 19.5% for A, 25.5% for boy. Okay. Next. I want you to think well for this one. A weakness of the internal rate of return IRR approach for determining the acceptability of investment. Is that it? Blank. Go. Okay, think well before you answer. You may pause this video if you have no answer yet. Okay? Sige. Bibigay ko na, ha? A weakness of the IRR approach is that letter A. It implicitly assumes that the firm is able to invest project cash flows at the project's IRR. What do you notice if you evaluate using IRR or internal rate of return? You would notice that you're going to just determine what that rate of return is. At the back of your mind, hindi mo na inaalam kung ilang taon yung project. Nakuha nyo? Pag nag-evaluate kayo ng IRR, iniisip nyo, sino mas mataas yung IRR? Si A or si boy? Tapos hindi nyo na inaalam kung ilang years operational yung project. No? In this example here, we have two projects, A and boy. A has an IRR of 30%, above that of project boy, which is only 25%. Evaluating based on IRR would make you conclude that A is better. However, you have to understand that the two projects may have different lives. While project A will earn 30%, it's operational only for 2 years. Si Project B, 25%, mas maliit, pero operational for 8 years. When you compare on the basis of IRR, it's unfair for boy. While boy has a lower IRR, it can actually operate for a longer, significantly longer period of time. So, what's my point? My point is, when you evaluate based on IRR, para bang nag-assume ka na yan na yung IRR sa buong buhay ng kumpanya. No? If you only look at the IRR without knowing how many years it will be operational, at the back of your mind, it's like you're saying that that IRR will be the rate of return on the project forever. No? Para bang nag-assume ka sa year 2, 3, 4, 5 hanggang forever, 30% na yan. Itong 25%, forever 25% na yan. Diba? Ulitin ko ha, kapag kino-compare mo yung IRR ng project, hindi mo usually inaalam kung ilang years yung project. So at the back of your mind, ina-assume mo na yung IRR na yan, forever na yan. No? So you implicitly assume that the firm is able to reinvest the project cash flows at the same rate of return. No? Kung 30% yung project A, after year 2, sa year 3, wala na si Project A, para bang nag-assume ka, kikita pa rin yan ng 30%, which is not necessarily true. So that's the weakness of the IRR. Kinompare mo yung IRR ng dalawang project, hindi mo inisip, no? Most of the time, hindi mo iniisip kung ilang taon yan. Mas mataas nga yung IRR, pero 2 taon lang. Ito, mas mababa. Pero 8 taon naman, no? Mas matagal talaga. Okay? So kung nagko-compare ka lang based on IRR, at the back of your mind, hindi mo na iniisip, no, kung ilang taon yung ang buhay ng bawat project. So yun yung problem, no. Ina-assume mo na kung ano yung IRR, yun na yung kikitain ng project for the rest of the life of the company. No? Even after mawala yung project na yun. Okay? So isa yan sa mga weakness ng internal rate of return. Okay? So by the way, hindi ko pala nabanggit pa. How do you evaluate the internal rate of return? You're going to compare the IRR to the hurdle rate. The hurdle or the discount rate. If the IRR is greater than the hurdle rate, that means that the project is profitable. If the IRR is less than the hurdle rate, the project is not profitable enough. No? Lugi ka. Yung kikitain mo mas mababa kaysa dun sa hinihingi ng mga investors mo. No? So how do you evaluate IRR? Compare the IRR to the hurdle rate. If the IRR is greater than the hurdle rate, well and good. If the IRR is less than the hurdle rate, okay, that is not profitable enough. Okay? The last tool that we will talk about is the profitability index. Profitability index. I'm going to use this sample case for this tool, no? This model. A project has an NPV of $30,000 when the cutoff rate is 10%. Annual cash flows are 41,010 on an investment of 100K. What's the profitability index for this project? Okay, I'll give you 1 minute to think about the answer. Okay. So, hindi natin, you may pause this video if you haven't answered yet. Okay, so what are we going to do here? Well, basically, the profitability index is very much similar to the NPV, except on the case of what will be the last step. Sa net present value, minaminus natin yung cost ng net investment mula sa value ng project. Dito sa PI, PI ito, no? Profitability Index. PI, ayan. Dito sa PI, dinidivide natin yung value ng project sa kanyang net initial investment. Okay, so given dito yung net present value, no? The net present value is 30,000. Ano yung net investment? What is the net investment? So the net investment must be 100,000, also given. 100,000 yung net investment. This is also given. So we can extract the value of the project. The project's value must be 130,000. Okay na? Ulitin ko ha. So yung NPV given, $30,000. I-add back mo sa net investment ng project. Makukuha mo yung value ng project, $130,000. So instead of deducting, yun yung ginagawa sa NPV, no? So we can tell a story that the NPV must have been arrived at by deducting 100 from 130K. In profitability index, we divide rather than deduct. The project's value, 130K, divided by the net investment cost, that's 100,000. Your profitability index is 1.3. PI, 1.3. The correct answer is D, as in dog. Okay? Correct answer is D, as in dog. So you call this the profitability index or PI. Okay. So pagdating sa profitability index, ito naman yung titingnan natin, no? We compare PI with 1. A profitability index above 1 means that the value exceeded the net investment, no? Kapag yung PI ay greater than 1, ang ibig sabihin nun, yung value mas mataas sa net investment. If the PI is less than 1, okay, that's not a good project. The value is less than the net investment. So ulitin ko ha, pag yung PI ay mas malaki sa 1, good project. PI less than 1, it's a bad project. No? We should recommend management to reject the project if the PI is less than 1. Parang sa NPV lang, no? Pag yung NPV naman, tinitingnan natin kung positive or negative. Dito sa PI, kung greater than 1 or less than 1. No? Ang importante sa atin, yung value ng project mas malaki sa cost ng net investment. Pag yung value ng project mas malaki sa cost ng investment, yung NPV maging positive, yung PI greater than 1. That's the time that the project can be recommended for acceptance. No? As accountants, we can only recommend decisions. No? Tayo yung nagre-recommend ng decision sa management. Okay? Conversely, if the PI is less than 1, ibig sabihin nun, yung net investment mas mataas sa value ng project. No? Kaya nag-less than 1. So yung NPV niyan magiging negative. Hindi maganda yung project na yan. Okay? That's how you use the profitability index. Okay. Let's answer the next one. I'll give you 1 minute. Go. Okay. Game? Barker Inc. has no capital rationing constraint, meaning walang problema yung pondo. Analyzing many independent investment alternatives. Barker should accept all investment proposals blank. Okay? The correct answer is boy. That have a positive net present value. So, wala kang issue sa kahit ano. You don't have a problem with money. Funds are always available. And then, you can accept all the projects that you want. Ibig sabihin, walang conflict dun sa project. You may accept project X, Y, and Z together. No? May tatlo kang project, no? X, Y, and Z. Ang tawag dyan, independent projects. If you can choose all of them all together, they are called independent. Okay? So this is an example of an independent projects decision where you have unlimited funds. Ano ang rule natin pagdating sa paggamit ng discounted cash flow techniques? We accept any project with an NPV greater than 0, which means that the IRR is greater than the hurdle rate, which means that the PI is greater than 1. So automatic na kapag pasado yan sa isa, pasado yan sa lahat. NPV is greater than 0, in other words, positive si NPV. IRR is greater than the hurdle rate, and the PI is greater than 1. That's a characteristic of independent projects. No? Any project would satisfy one of these, would satisfy all of them. Now here's a problem. Sometimes the projects are not independent. The opposite of independent projects are mutually exclusive projects. These are projects wherein choosing one would mean reject the others. You can only choose one. Choosing one project would mean that you have to reject the others. Yun yung ibig sabihin ng mutually exclusive projects. So what do you do? Walang problema pag independent yung project. Lahat kasi ng NPV positive projects, IRR nila greater than hurdle rate, PI nila greater than 1. Magkasundo itong tatlo kung sino yung mga pasadong project at sino yung mga project na bagsak. No? Magkasundo sila kung sino yung pasado at sino yung bagsak. Pero, hindi sila magkasundo kung sino yung pinaka magaling. While they agree which projects are acceptable and which are not, they disagree on which has the highest measure. X may have the highest NPV, but Y may have the highest IRR, and Z may have the highest PI. Yung projects na pasado sa isa, pasado rin yan sa lahat. Magkasundo yung tatlo. Pero hindi sila magkasundo kung sino yung number 1. Para kay NPV, number 1 si X. Para kay IRR, number 1 si Y. Para kay PI, number 1 si Z. So what do you do? So here is the rule that we will follow. We prioritize the one with the highest NPV. In case of conflict among the measures, you decide on the basis of NPV. What's the NPV? The NPV is net present value. V is for value. So ano ibig sabihin nito? Remember that our goal in financial management, which is to be discussed in some future time, our goal is to maximize shareholders' wealth. Okay? What's our goal? Maximize shareholders' wealth. What is shareholders' wealth? Shareholders' value. So piliin natin yung project na may mataas na net present value kasi yung priority natin is to maximize shareholders' value. So choose the project with highest NPV. Okay. So we have a situation where the projects are independent. You have unlimited funds. You do not need to choose which technique to use. You would find out that they will agree with one another. However, if the projects are mutually exclusive, you can only choose one. The one with the highest NPV is not necessarily the one with the highest IRR, is not necessarily the one with the highest PI. In case of this conflict, our priority is to choose the one with the highest net present value. No? Ganon tayo pagdating sa mutually exclusive projects. No? Ganon tayo pagdating sa mutually exclusive projects. Now, What about if the projects are independent, but your budget is limited? Your funds are limited. You need to ration your capital. This is the rule that we are going to follow. We choose as many projects that fits the budget. Kunyari, 1 million lang yung pera natin. So lahat lang ng project na pasok sa 1 million and prioritize according to the profitability index. Okay, as I'm going to show later on, if you prioritize according to profitability index, that is, you will rank the projects, sino may pinakamataas at pinakamataas na PI, no? Yun yung mauuna. You would end up with a greater probability of maximizing the total NPV, no? Hindi necessarily yung highest NPV, ha? Kasi baka mamaya pinili mo yung highest NPV una, naubos agad budget mo, wala ka ng ibang matanggap, no? So hindi pwede based on NPV agad. You rank according to PI para masulit yung paggamit ng pondo. Anyway, I'm going to show it to you in a later problem. In the meantime, please answer this one. With regard to the net present value and internal rate of return, mutually exclusive projects are those where blank. As always, you can pause, no? Bibigay ko na yung sagot. So what do we mean by mutually exclusive projects? Mutually exclusive projects are those where the acceptance of one project exclude other projects from consideration. Excuse me. Again, mutually exclusive projects are those where the acceptance of one project excludes other projects from consideration. Yun yung meaning ng mutually exclusive projects. So the answer is letter C. Okay? What about this one? Lewis Services is evaluating 6 investment opportunities or projects. The following table reflects each project's NPV and their respective initial investments required. All of these projects are independent. Lewis has an investment constraint of $100,000. Which combination of projects would represent the optimal investment that should be recommended to Lewis Services Management? For this one, I'll give you around 3 minutes. Okay, just continue answering. Magbabasa lang ako, ha? Para umuusad tayo. Lewis Services is evaluating 6 investment opportunities or projects. The following table reflects each project's net present value and the respective initial investments required. All of these projects are independent. So you have here positive NPV projects. So kung pwede sana lahat sila kunin natin, no? Positive naman NPV. Kaso ito yung problema. While they are independent, we have a constraint in the budget, $100,000 only. Lewis has an investment constraint of $100,000. Which combination of projects would represent the optimal investments that should be recommended to Lewis Services Management? Okay? Sige. I'm going to give you 1 more minute. I'm going to give you 1 more minute. Okay na? Pause lang kayo ha, kung hindi pa tapos. If you haven't finished yet, you may pause this. Okay. So you might be tempted to say that to maximize your NPV, you choose the project with the highest NPV. For example, Project V has an NPV of 15,000. Tama? So together with you, Project V has the highest NPV. However, if you will do this, you will end up using up the entire 100K. In this case, gagamitin mong pera 75,000, mauubos agad yung 100,000 mo. So para maging efficient yung pag-allocate ng resource, ang gagawin natin, pataasan ng PI, no? So sinong pinaka-PI, no? Yun yung pinakamataas yung PI, siya yung mauuna. Para masulit natin yung 100,000. Papakita natin, ha? Okay. What's the value of the project? The value of the project is, for letter R, Project R, 5K plus 10K. No, i-work back natin yung value ng project, no? Itong NPV kasi value minus investment. So para makuha yung value, i-add back natin yung NPV sa investment. 5K plus 10K. 15K. 15K yung value divided by the cost of investment of 10K. You have 1.5. That's the PI. S. You add back 5K to 5K. The value would be 10K. 10K over the investment of 5K is 2. That's the PI. T. 8K plus 40K is 48K. 48K divided by 40K is 1.2. U. 15 plus 60 is 75. 75 over 60 is 1.25. V. 15 plus 75 is 90. 15 over 90 is only 1.2. And then W, 3 plus 15 is 18. 18 over 15 is 1.2. So this is what we're going to do to optimize, no? To maximize the use of the funds. Prioritize the project with the highest PI. In this case, it's project S2. Sir, maliit ang NPV niya. Ba't natin siya inuuna? Maliit nga yung NPV niya. Kaso maliit din yung investment. By taking project S, your NPV is now 5,000. Although you only consume 5,000. 100 minus 5K, halos hindi gumalaw yung pera mo. It's like you haven't touched your money yet. You still have 95,000 available. So sinong number 2? Second highest PI is Project R with a PI of 1.5. You will have an additional 5,000 in your NPV using an investment of only 10K. 95K minus 10K, you still have 85,000. Para masulit natin yung paggamit ng pera habang dinadagdagan natin yung NPV, unahin natin yung may pinakamataas na PI, no? So pag capital constraint, no, kulang yung ating pondo, isipin nyo lagi, kunin nyo yung pinaka-PI muna, no? Pinakamataas yung PI. O, sinong number 3? Si U. Okay, U has an NPV of 15K. You will only consume 60,000. You will end up with 25,000 funds. At this point, T, V, and W are tie. Pero yung pasok na lang ay 25,000 na investment. Si W na lang yung pwede natin makuha. No? So the projects to be accepted are S, R, U, and W. So in no particular order, the correct answer is letter dog. No? R, S, U, W. No? Dito in order, ha? Yung tamang order, SRUW. Ito yung tamang combination, no? Hindi lang tama yung order, RSU and W. Correct answer is D as in dog. So, ganun tayo mag-prioritize ng constrained resource, no? In this case, capital available natin 100K lang. So, sagarin natin yung paggamit. Sulitin natin yung paggamit. Unahin nyo yung may pinakamataas na PI. Sa bawat piso na ini-invest natin doon, yun yung pinakamataas na value may bibigay sa atin. Kasi pag kinuha nyo yung highest NPV, katulad ni Project V dito, no? Project V may have the highest NPV. But if you will accept Project V, there will be no more room for the other projects kasi 75K agad yung kukunin niya sa investment. Okay? So that's how you use the profitability index in dealing with a capital constraint. Okay. Here's the next question. Capital rationing. How do you define it? Go. Okay. Answer? The correct definition of capital rationing, which is what we did here, is to allocate the available capital to the highest ranking projects in order to maximize shareholders' value. Kung titignan ninyo, yung total NPV ni RSU and W, 5K plus 5K plus 15K plus 3K, that's 10, 28,000 yung total NPV. No? Kung papansin niyo yung combination na pinili natin, yan yung may pinakamataas na NPV. Compare niya sa ibang choices na posible. No? Compare niyo yan sa ibang choices na posible. Mas mataas yung combination na nagawa natin. Capital rationing is a process of allocating available capital to the highest ranking projects first, in order of PI, in order to maximize shareholders' value. That's the meaning of capital rationing. Okay, so I'm going to end the discussion here. That would sum up our discussion on capital budgeting. Okay? Then I'm going to give you a set of exercises that you are to answer first before proceeding to the final video. No? So I'm going to prepare a third video after this one.